Leighton Holdings has confirmed what most people had already guessed, which is that it has continuing serious problems at two of its biggest projects in Australia. The result is that another $250 million will be wiped from Leighton's full-year profit, with some analysts expecting more to come. Andrew Robertson reports.
It just keeps getting worse for a company that's lurched from one crisis to another over the last 18 months or so.
This is a very disappointing call to make, and I'd like to start by apologising to shareholders for the bad news that we're going to be delivering.
What Hamish Tyrwhitt delivered was another major profit downgrade, courtesy of the Brisbane Airport Link Road and the Victorian desalination plant. The financial position of the Airport Link Road has deteriorated by $148 million, the desalination plant by $106 million. As a result, Leighton has cut its full-year earnings guidance by a third to between $400 and $450 million. Half-year profit is expected to be between $100 and $150 million.
Only 6 weeks ago, Hamish Tyrwhitt was standing up saying that the progress was going well on these projects, that all issues had stabilised. Now we've got significant losses being announced. That's never good from investors' perspective.
Investors knew more bad news was coming because Leighton shares had been in a trading halt for 2 days. A trading halt no doubt helped by this month's $300,000 fine from the Australian Securities and Investments Commission for breaching its continuous disclosure obligations. That was in relation to last year's $907 million earnings write-down, which prompted a $757 million capital raising. Adding to its woes, Leighton is also being investigated by the federal police over allegations of paying bribes to help win business in Iraq. Not to mention the revolving door at the top of the company, which saw long-time Chief Executive Wal King, his successor David Stewart and the Chairman David Mortimer all leave within a few months.
It is a company in crisis. They've taken some very significant steps towards getting themselves out of being a company in crisis, but today's announcement is a clear indication that we're still there at the moment.
Steve Johnson makes the point that the latest write-downs stem from decisions made under the aggressive tendering strategy of the Wal King regime. What he's worried about now is what lies ahead.
There's a real concern here about Leighton's risk management systems, and that's a concern for the $44 billion of work that they've still got in hand that are future projects and potential losses that might come from those.
On the subject of losses, the most immediate concern for Leighton shareholders is their dividend, and it's not looking good.
Leighton's tries to pay out about 60-65% of their earnings as a dividend. With a 30% drop in earnings, you can expect that dividends will fall by 30% as well.
Just what Leighton shareholders needed to hear on top of their stock losing 7% in value after the profit downgrade announcement. The bigger question is whether or not this is the end of the pain.